Even if you never prepare a statement of cash flows after you finish your study of financial accounting, there's a pretty good chance that you will be looking at statements of cash flow and analyzing them in your professional careers. That's why it's really important to understand the story that the statement of cash flow can tell you. Now, what I have over here is really intended to describe what cash flows could look like for a company during its introductory stage, so a brand new company, and then during the growth stage, maturity, and then finally into decline. So this is an illustration of potential cash flows over the entire life cycle of a business. As you can see, when a company is brand new, take a look at what's happening. The operating line is blue and the investing line is orange. So a brand new company has no resources, but it needs to build its infrastructure and it needs to operate, and both of those are going to require cash. So if over here we're in the negative, because everything below this black line is negative, everything above this black line is positive, or cash coming into the organization. So if we have down here cash leaving the organization because we're investing in infrastructure and we're paying for operating expenses, well, where is that cash going to come from? It's got to come from financing activities, this green line right here. We're either going to need to issue stock and obtain funds from investors, or maybe borrow money from a bank or from another lender. But those financing activities really are providing the seed money that we need during this introductory phase. And we see during the growth phase as well. A growing company, if you look at this orange line, a growing company still will have needs for capital expenditures and further investment in infrastructure. Now, as the company completes its growth cycle and heads toward maturity, hopefully we kind of level off and we have to stop. We don't have to keep purchasing equipment and buildings and things like that. So it would be natural that this orange line, the investing cash flows, kind of approximates something towards zero, or maybe just slight investments in the long run. And we also hope that the blue line, the operating cash flow, starts to become positive, because ultimately that is going to be essential for a sustained business model. And somewhere during the growth phase, hopefully this line becomes, into the positive area. Now, as we do that, what you're seeing with the green line is we need to rely less and less on outside financing sources. We may not need to issue more stock. We may not need to borrow more funds. So eventually what's going to happen is that financing line becomes zero. And even when we get into maturity, now that we're generating positive operating cash flows, which you kind of see the blue line under my finger right here, during this maturity phase, this thing is a cash machine. It's printing money. Well, what are you going to do with all that money? You're going to pay your investors dividends, potentially, and you're going to repay debts that you incurred during your introductory and growth phases. So what you can see is, and of course this is just one hypothetical illustration, but for a mature entity, it would not be unusual to see these operating cash flows distributed to owners. So down here, above this, this marker right here, you can see the green line is in the negative cash flow. These are cash outflows because we're probably paying some dividends to investors, we're repaying bank loans, and that money is going out the door, but that's a good thing. I mean, this really in the maturity phase here is showing a healthy company. A company that has positive operating cash flows with the blue line up here. We have negative financing cash flows, and that may be perfectly acceptable because we're getting rid of debt and we're paying dividends to investors. What a wonderful thing. Now, the investing line, it's kind of hard to say if that's good or bad. On one hand, I might say, is this company really investing in growth? Should they be complacent, with very minimal investment in infrastructure? And that's going to be a facts and circumstances discussion. Now, eventually, if a company comes to a decline phase, look what's happening on the very right-hand side here. During the decline phase, you would expect operating cash flows to suffer, and we are seeing that. Over here, the operating cash flow is declining. The investing cash flow actually becomes sharply positive. That's because we're selling our infrastructure. We're selling equipment, selling buildings. We're selling the things that we used to use to generate profits. And we're going to receive some cash for that, some kind of salvage value. There's a little bit of liquidity. And you can see finally the financing cash flow drops off precipitously because we're kind of doing this final stage, the end of life, if you will, for the company, where we're paying off final debts, maybe paying liquidation payments to our shareholders or something like that. This is just one example. It's not necessarily exactly the way a business's life cycle would play out, but it's an illustration to show that the statement of cash flows can give you some insight regarding what phase of life cycle the company is currently experiencing. When you take a look at the operating section of the statement of cash flows, the number one consideration should be that this number is positive on a sustained basis. Oh, sure, there might be instances where a company has net cash used for operating activities, in other words, a negative number here on occasion. But in the long run, if a company wants to stay in business, it needs to have sustained operating cash flows that are positive. Okay? The bigger, the better. If you continually bleed cash because of your operations and you don't have another source of financing, eventually what's going to happen is investors will stop investing money, lenders will stop loaning money, and the cash that's bleeding out here, you won't have a way to replace that. There will not be a source for offsetting that cash flow. A company that generates negative operating cash flows on a sustained basis would be kind of like you living your personal life on credit cards without ever having any kind of resources to pay those credit card bills. Okay? So if you take nothing away from this discussion, is that it's this right here. Operating cash flow needs to be positive on a sustained basis. Now, of course, once you have that concept in mind, you can start to look at some of the finer details, the nuances. For example, you might want to take a look at the relationship between net income and cash provided by operating activities. You probably want to look at a trend analysis over a number of years, and you can start to see things like this right here. One of the adjustments is that accounts receivable increased by $1,000, right? So we had to subtract that increase. Well, guess what? If you continually see that happening, if you see that net income is strong, but every year, every period we have a subtraction because accounts receivable is increasing, that's a potential warning sign for fraud, fraudulent financial reporting. Because I'm not saying this is happening, but what could be happening is that the company is inflating its revenues and dumping that into accounts receivable, but nobody's ever paying the receivable. It's just one possibility. So positive operating cash flow, that's a for sure. Okay, and then some of the nuances, we want to dig into those details as well. When it comes to the investing and the financing sections, there really is no hard and fast rule that says positive is more favorable. I mean, you can take the operating activities to the bank. We need positive operating cash flow on a sustained basis. But I can't say the same thing for these two sections here. Because you see, take this for example. This coffee house is bleeding cash in its investing section, but it purchased equipment. Okay, it needs equipment to be able to run its business. And as long as that is a wise decision, if that's a good use of resources, if the company will be able to use this equipment to operate a successful business that generates positive operating cash flow, then this negative amount right here could easily be the sign of a healthy, growing business. Now, actually, flip it around. If your investing activities section shows a positive number, pause and think about what that really means. That means the company is selling its infrastructure. If it's a coffee house, that means they're selling their espresso machine. They're selling their furniture. They're selling their cash registers and maybe buildings or whatever assets they have. And sure, that might be a source of cash in the short run, but eventually, if you sell enough espresso machines and enough tables and chairs, if you sell the infrastructure that you use to generate a profit, you no longer have a business because you wouldn't have any resources to conduct your operations. So you actually should be cautious if you see positive investing cash flows, especially pervasive positive investing cash flows. That should cause you to wonder, is the company struggling? Are they liquidating assets to try to cover up operating cash flow deficiencies or something like that? It should make us have a question. In the financing section, it honestly can go either way, okay? If you see positive financing cash flows, that could be the sign of a healthy business that is attracting investors, that is convincing banks and other lenders to loan money because they're growing. It would not be unusual in a growth phase to see positive financing activities and then negative investing because we're using these resources to invest in our growing infrastructure. But also, if you saw negative financing cash flows, that could be the sign of a very healthy, mature business that is paying dividends to its shareholders, that is repaying liabilities, long-term debt, things like that. And that could be a wonderful thing too. The company's balance sheet could become stronger. It could become a more attractive business if we see negative financing cash flows. So the reality is this: operating cash flow needs to be positive in the long run. That's a given. Investing and financing cash flows, they could go either way. You really need to analyze those in context with other elements of the financial statements and with your overall knowledge of the business and its strategies. So the reality is, positive operating cash flows, that's a given. We need it. The investing section, the financing section, we have to take a look at that in context with what's happening elsewhere in the company, what we're seeing elsewhere in the financial statements, with our overall understanding of the company's life cycle, its business strategies. We can't just say that positive is good or negative is bad. We have to take those amounts in context with other pieces of information. But at the end of the day, remember this: cash flow is the lifeblood of every organization. And the statement of cash flows is so critical to supplementing the accrual basis income statement and the accrual basis balance sheets and other information that we have in the disclosure notes and whatnot to let us know where is cash coming from, where is it going. Because at the end of the day, every business needs cash in order to pay its bills.